Well, Australian and US markets are on the verge of a technical correction, but is there more selling to come? So hi there everyone, welcome to the Traders Circle weekly market update. It is Tuesday the 11th of March 2025, and before I get started, you do need to be aware that whatever I say is general advice only. A technical correction is defined as a 10% fall from a peak. Our market closed 8.5% off our February high, very close to that 10% mark. The 10% is just a rough guide. We've seen things with less be called a correction, and obviously things to a greater fall called a correction as well. Usually a correction is seen as the market moving back to towards more normal levels. This time around, there's no guarantee that we've returned to normalcy. There's no guarantee that we will bounce here. We've seen an awful lot of selling, and it has happened very, very quickly, but we haven't also seen that return of buyers that usually heralds the return from the correction. The correction is usually something that where the market returns to a longer term trend, or continues in its upwards movement, continues in its bullishness. But I would suggest that this correction might not be over just yet, and we might not be about to return to a bullish market. There's a lot of negative factors for the market to weigh up, and we'll touch on those in a moment. But the other thing to weigh up is that our valuations are also quite elevated. And we will also elaborate on that a little bit further. The other thing to note about a correction is usually they take a bit of time to happen. Usually you see a bit of downwards move, push back up, and then some further selling, and it takes a few peaks and troughs to get there. This time around, the correction has happened all at once. It's been a very sharp downturn. There's been very, very little bounce back up on green days, and where that has happened, it's immediately been sold down the very next day. And that's also perhaps not a great sign for this correction bottoming out in the near term. So why are markets correcting? Well, the big news is tariffs. We've seen tariffs on Canada and Mexico. Some of them have been paused or removed or halted. Some of them have been increased. We're going to see tariffs on steel and aluminium tomorrow night, and then we're going to see the quote-unquote reciprocal tariffs be placed on the 2nd of April. You might assume that Australia doesn't have any tariffs on the US. We're not going to get tariffed ourselves. But Trump's trade advisor has indicated that he sees our GST as a tariff on US exports to Australia. And so, despite their own sales taxes, which are state-based basically, we could see Australia get tariffed by the US as well. These tariffs are not good. They reduce economic activity. They increase prices, they basically slow down the economy. And the longer these tariffs remain in place, the more likelihood there is of a US recession. And if there's a US recession, fair chance the rest of the world also sees a big downturn. A lot of people are saying these tariffs, they're just bargaining chips. They're just going to be in place for as long as it takes for Trump to get his way. But that's not guaranteed to be the case, and a lot of nations who are being tariffed or who may be tariffed have indicated a willingness to battle it out, to have a trade war. That puts the US at a big disadvantage. Their trading partners are only getting new tariffs from the US, whereas the US is going to have new tariffs from everyone. So they're going to be fighting on 100 fronts, while everyone else will have a single front trade war. So I'll reiterate that the longer these tariffs remain in place, the worse things will get. And that's what markets are absolutely fearful of. So we're seeing any news about new tariffs or increase in tariffs or things like that, we're seeing them be sold down very, very heavily on stock markets. Similarly, any news that the tariffs are being paused or being reduced, we're seeing markets buy back up. But at the moment, everything is negative, and where we have seen the small bits of positivity, it's been minuscule compared to the big bits of negative, meaty tariff news. So, that's the story dominating markets at the moment. We've actually had some positive news in Australia, and the market has just seemingly ignored it. We had better than expected fourth quarter GDP growth. That was enough to take us out of a per capita recession. We've actually been in a recession per person for I think close to 2 years now. So, that strong GDP growth took us out of a per capita recession. Market didn't care one bit. We've seen recent Australian price data show that inflation is coming back towards the RBA target range, potentially opening the door for more rate cuts. Market didn't care one bit. It's only seemingly caring at the moment about the tariffs, about what's happening in US share markets, and that's just leading us lower and lower. So I did want to touch on the fact we've fallen off quite strongly, and it would be easy to say, well, prices are now cheap, time to buy, time for things to go back up, but our market's actually still quite expensive. Compared to our historical levels, our prices relative to earnings, our prices relative to dividends, our prices relative to future earnings remain very elevated. And so even though we're on the verge of a technical correction, we've fallen very strongly off a recent peak, our prices are still actually very expensive, and that does leave further room to the downside. As I touched on with the tariffs, it's going to be entirely dependent on what happens there, what happens in US markets, and if the tariffs, there is a tariff reprieve, our market will probably join in the rally as well. But I do want to just sort of bring this up to say that we do have further room to the downside from a valuation perspective, from a numbers perspective. You look at some of our banks, they're still very expensive. You look at our technology stocks, they're still extremely expensive. And that does mean there is a potential for further selling, and that will come if the tariffs remain in place for any period of time. Now, valuations have become stretched around the world, and they remain very, very high in the US and in parts of Europe, many other parts of the world, and they probably will remain high in Australia. The big driver of those extreme valuations that we saw and that we are still seeing has been extreme levels of US government spending. The US government deficit remains extremely large, and for as much noise as Trump and Doge have made about cutting US government spending, the reality is that their budgetary proposals have only been to increase the deficit. They're going to increase US government net spending, and that's by increasing US tax cuts for the very wealthiest individuals. This amount of US government essentially money printing has pushed valuations up, and that money printing is continuing. It's actually only going to get worse from here as things currently stand. So with that money printing increasing, it does mean that we probably will see valuations remain elevated. So I just wanted to say that, to keep that in mind, that tap of liquidity to markets from US government money printing is only expanding. So despite that sort of negativity from the tariffs and from the economy potentially contracting, we are still seeing a lot of liquidity flow in, and that might prove a bit too much for and overweigh the negativity at some point. It doesn't look like we're close to seeing it anytime soon though. So let's have a quick look at the charts for this week, guys. And this is the XJO, the top 200 stocks in the Australian market, and we can see we've had a pretty big sell-off since the middle of February. We reached about 86.15 in the middle of February, and since then we've fallen off about 8.5%, more than 9% at the lows of today. Seemingly we found some support right around 78.70. That was a bit of a historical level. It was resistance for our market back in mid and early 2024, and we then broke it and we've traded above it pretty much since the middle of 2024. We've bounced off that level today. It doesn't look like a super convincing bounce, and if we do have much upside, I'd be looking at this short-term downtrend line and maybe 80.60 as a maximum upside target before a resumption in selling. Now, obviously, if we do get a bit of a reprieve on tariffs, it could be that we push through those lines, but I would still assume that we'll set a lower peak and then potentially retest this trough and then maybe even a lower trough after that. If we have a look at the US market, and this is the S&P 500, the most broad-based and largest US share index. They've also broken their uptrend line. They've fallen since the middle of February, and they've fallen back to a previous resistance level, probably right around 56.30, 56.20, maybe even as low as 5600. They tested that level overnight, they fluctuated around it, and they closed roughly right on it. If they do bounce back up, again, I wouldn't be expecting too much to the upside. Maybe 57.50, maybe this downtrend line. I do think that we'll probably see a further drop from here, like I said, with the tariff news, with all the negativity going on, with perhaps investors losing confidence in Trump as a president. If we do see a close below this sort of 5600 level, let's say, I think we'll see a move back towards 5400, well and truly beyond a correction range. So we'll wrap it up there for this week, guys. Global markets, particularly in Australia and the US, in the process of correcting, big sell-offs, and potentially more to come unless we see a bit of a change up in the news. Like I said with the tariff section, if we do see these tariffs remain in place for any length of time, I think we will see the US market start to head towards a recession. That's not going to be good for everyone, and it won't be good for share prices. So hopefully you guys enjoyed this week. If you did, click like, click subscribe, and we'll see you guys next time.